Hello everyone, this is Shawn Danziger from Summit Advisory Group. And I first want to say that although I haven't seen many of you recently, I have been thinking about all of you. My hope is that you and your families are safe and healthy. I know we all look forward to moving past this and getting back to our normal lives. I've received many questions from you as we watch the news and the stock markets each and every day. I want to reinforce the importance of staying the course when it comes to your investments and your financial strategy. You've heard me say many times that it's time, not timing, that matters, and we have to always take a long-term view. Rest assured, you can find peace of mind knowing that I'm watching things very closely and that your long-term success is my priority. I appreciate the confidence you have placed in me over the many years, and we will get through this together. As always, I'm here if you have any questions, and I encourage you to reach out. In the meantime, please enjoy this video as a way of addressing some of your concerns. Stay safe, stay healthy, and know that I'm here for you. Welcome to our 2020 Investor Update. Today's agenda is straightforward. First, I'll share a brief investor update. Then I'll discuss some planning ideas and strategies that you can consider. Before I get to the presentation, I'd like to take a minute to remind you to stay safe and please try to also stay positive. We're all experiencing challenging and unprecedented times, but as Ralph Waldo Emerson said many years ago, the first wealth is health. Before I begin, I find it's always important to review that there are 5 key areas of financial planning. First, preservation planning, retirement planning, tax planning, estate planning, and investment planning. Even though today's presentation is about the equity markets, as a comprehensive wealth management firm, I try to always consider the impact of any recommendations I make on not just one, but all of these areas for our clients. What if I told you a global recession was coming? The US might start a recession. There was going to be a trade war with China. The president would get impeached, and the Middle East would fire rockets at our US military bases. Would you have expected the stock market to go up? Well, that happened. And despite all of those concerns, 2019 was a healthy year for investors, and 2020 started on a strong note. Then, in mid-February, after making a new all-time high, things changed quickly. A silent but deadly virus quickly decimated an 11-year bull market. After the strong year that was not foreseen in 2019, in less than 3 weeks, the S&P 500 fell from a 52-week high to a 52-week low. This quick waterfall of the equity markets has set many records. Although most experts predicted a reasonable year for 2020, we are now in an unexpected period where it seems as if the economic outlook is evolving daily. Knowledge is power. I believe an educated client is our best client, so let's examine some of the data. After an 11-year bull market, we quickly entered a bear market. A bear market is defined as when the market falls at least 20% or more from its 52-week high. A bear market's most basic principle is that bear markets are a part of the investing experience. Since entering the bear market, as of early April, a bounce back of equity markets may have ended this bear market, but we're still in very volatile times and are down from all-time highs. Since we're discussing bear markets, which is a close of 20% down, it might be helpful to review some information about bear markets. Bear markets can be classified in one of 3 categories: structural, cyclical, and event-driven. Structural bear markets are those created by imbalances and financial bubbles, very often followed by a price shock such as deflation. This happened in 1929 and again in 2008, when the financial system was in trouble. A cyclical bear market is one that typically is a function of the economic cycle, marked by rising interest rates, impending recessions, and falls in profits. Then there's event-driven bear markets, which are created by events such as war, an oil price shock, an emerging market crisis, or like most recently, a sudden viral pandemic called COVID-19. After lowering the federal funds rate by a half a point or 50 basis points to a range of 1 to 1.25% in between its regularly scheduled meetings as a response to the risks the COVID-19 coronavirus outbreak was creating, the Federal Reserve cut its benchmark interest rate in mid-March by a full 1% to between 0% and 0.25%. When the Fed first started reducing interest rates, many experts noted that the central bank was catching up to where markets had headed. Now it seems as if they're responding to both the economy and the fact that the 10-year Treasury had fallen to all-time lows. The all-time low for the Fed funds rate is effectively 0. The Fed has only lowered their rate to a range of 0% to 0.25% twice, once during the financial crisis of 2008 and now again in March of 2020. The U.S. government is responding by trying to prevent the threat of a recession and help businesses. They have passed several bills, including the $2.2 trillion Coronavirus Aid, Relief, and Economic Security Act, also called CARES. This emergency relief package is the largest economic relief package in U.S. history and will likely get expanded. As if things were not bad enough, the oil price war between Saudi Arabia and Russia, which emerged suddenly and dramatically on March 7th, decimated the energy industry. Oil prices saw the worst month and quarter in oil price history, down over 50%. With energy companies and oil still being a contributing factor to the overall economy, oil prices added to the equity market's problems. A bad decision could be harmful. As this chart shares, the 6 biggest point declines and the 6 biggest point increases in the Dow Jones Industrial Average all came in the last 5 weeks of this quarter. On March 12th, the Dow Jones Industrial Average fell 2,352 points, which was over 9%. Had you sold that day, you missed the next day's March 13th rise of 1,985, also a move of over 9%. This level of volatility is unprecedented, and therefore even the savviest of investors needs to proceed with caution. The volatility and turbulence of this current economic and political environment has caused even some of the most seasoned investors to become skittish. In March, legendary investor Warren Buffett said that he hadn't seen anything like the coronavirus pandemic. Bespoke explained in a post noting that the average stocks in his top holdings on March 24th were down 37% from their February highs. Perhaps the most important thing to think about is that, like everybody else, his portfolio obviously has been immune to all this volatility. This is a good time to recall one of his most famous quotes: "The stock market is a device for transferring money from the impatient to the patient." How should an investor approach the rest of 2020? We advocate being prepared and not scared. How should an investor move forward? One of our responsibilities is to look at all situations and guide our clients with ideas. Even a treacherous downfall has opportunities. Let's review some of them. Thinking long-term is still the way to look at equity investments. Typically, the most successful investors think and act for the long term. It's near impossible to predict exact market movements. However, you can prepare. While no one likes losses, from a tax standpoint, they could be helpful. For example, a tax swap is a strategy that involves selling investments that has losses and replacing it with a similar but not identical investment. This tax loss can then be used to offset gains, or it could be banked to offset future gains. Now, this doesn't apply to IRA accounts or retirement accounts in general, but this is something that in a non-retirement account could be helpful on your tax return. There are some rules to understand, like the wash rule. So if this is a strategy you want to discuss, then please call my office. Maintaining a properly designed and well-diversified portfolio is important. Now is a good time to look at your portfolio and consider any rebalancing that may need to be performed. For many investors who had a 60% stock, 40% bond portfolio a few months ago, this percentage may have changed in the past few weeks. I stay on top of this and do rebalancings when appropriate. For some investors, this could include selling things that have risen and buying things that have fallen. This could sometimes be a good opportunity to invest at lower prices. The required minimum distributions for 2020, also called RMDs, for some retirement accounts have been waived. Some investors may not need to take distributions from their retirement accounts at this time. If you're comfortable with suspending distributions and looking for a potential better time to take them, please call my office and we can see if this strategy works for your personal situation. Though they can be complicated, there are many reasons to consider Roth conversions. These include, depending on who wins the presidential election this year or how much the government injects into their stimulus, there's a chance that for some investors, tax brackets may rise in the future. Also, for many retirement accounts with equities, account values are down. This can create opportunities, especially for those investors currently in the 12%, 22%, and 24% tax brackets. Another reason to think about the pros and cons of Roth conversions is the new Secure Act's changes to inherited IRAs. As a reminder, on December 20th, 2019, a major piece of legislation known as the Secure Act was signed into law. This new act brings massive changes for those of us with retirement savings. While I'm not reviewing the Secure Act today, it has a new 10-year rule that now says that most inheritors can no longer stretch out their inherited IRAs. They now need to plan to take out these funds within 10 years of the date of death. That means we should review your retirement plan sometime this year and look into the family tax management of you and your beneficiaries. The deadline for filing 2019 income tax returns has been officially changed to July 15th, 2020. The deadline for making 2019 IRA and HSA contributions has also moved to July 15th. Deadlines for contributions to workplace savings plans have not changed. Please check with your state for any changes to state filing deadlines. Equity market volatility is back, and it can be scary. That's why we always talk about being cautious and having a long-term focus on your plan. Fear sells, and everywhere you look, the media magnification of the current financial crisis is putting a major emotional strain on most viewers. During these times, it's prudent to resist the temptation to watch news reports and obsessively watch your portfolio performance. Sometimes the more information you have, the more likely you can make a decision that deviates from your long-term strategy. Adhering to a long-term investment plan often requires taking the news with a grain of salt and putting the impromptu advice of others on the back burner. Remember, panic and bad decisions can cause more harm for investors than a virus or downturn. As a recap, what are some key takeaways for investors? 2019 produced strong returns for equity investors. Extreme volatility has reemerged. Your health is our first priority. Continue to focus on your personal goals and call with any concerns you may have. So what can you expect from us? You can expect regular communication, more frequent discussions, and you can expect that we continuously are reviewing your economic, tax, estate, and investment issues for all our clients. Thank you for your time today. Remember, your health and well-being is my highest priority. I appreciate the opportunity to assist you with your financial needs. I'd like to help others in 2020. In fact, I'd be honored if you could share some names of friends or relatives, people that could benefit from the work that I do, so that we could add those names to our mailing list so that they can also enjoy the information that I send out on a regular basis to my clients. Feel free to share this video to your friends, relatives, and again, anybody who could benefit so that they could get value from it.